Financial services emerged as the largest employment category for the Columbia MBA class of 2025, accounting for 35.4% of total hires. But the aggregate figure conceals a sharply uneven distribution of hiring across its constituent segments. Investment banking alone absorbed 17.1% of the graduating class, making it the single largest function within financial services and accounting. This elevated share reflects how capital market activity evolved after mid-2024. While overall global deal counts remained subdued, deal value rebounded selectively, particularly in North America. Q4 2024 and Q1 2025 saw a resurgence in large execution-intensive transactions, including mega deals, carve-outs, balance sheet restructuring, and continuation vehicles backed by private equity sponsors. These transactions required immediate analytical capacity and execution bandwidth, leading banks to prioritize MBA hiring in New York-centric associate roles despite maintaining tight overall headcount discipline. The stability of the $175,000 median base salary and $50,000 guaranteed compensation reflects a market where banks needed talent but not in traditional due diligence. Beyond investment banking, the buy-side segments hired far fewer MBAs but at materially higher compensation levels, reinforcing the theme of selectivity over scale. Investment management accounted for 6.8% of hires, continuing a multi-year contraction from earlier peaks. Between Q3 of 2024 and Q2 of 2025, asset managers face persistent fee compression, accelerating fund flows into passive products and increasing automation in research and portfolio constructions. Hiring concentrated in roles requiring cross-asset judgment, quantitative fluency, and AI-supported decision-making. Demand for traditional analysts have dried up. This narrowing of roles explains why investment management offered $75,000 in guaranteed compensation, lifting total median pay to $250,000 despite its reduced hiring share. Private equity hired 4.5% of the class, consistent with its structurally limited but highly competitive intake. The timing of the class of 2025 is critical here. Although global PE deal value ultimately surged in late 2025, the earlier part of the period was dominated by exit delays, DPI pressure, and fundraising strain, which constrained team expansion. Sponsors hired selectively for candidates capable of supporting AI-enabled due diligence, operational value creation, and portfolio optimization. Deal sourcing alone was not a unique talent in 2024-25. This labor scarcity and changing skill requirements are directly reflected in compensation, with guaranteed pay exceeding $137,000 and total median compensation surpassing $312,000, the highest across all industries. Venture capital hiring declined further to 2.5% of the class, reflecting the sharp concentration of venture funding during this period. While headline funding rounds in AI infrastructure and foundational models dominated market attention, more than 3/4 of venture capital deployed between Q3 of 2024 and Q2 of 2025 flowed into a narrow set of late-stage or platform-level investments. Early-stage and generalist funds reduced hiring, extended fund cycles, and delayed new partner additions. VC roles remain limited and opportunistic, with compensation structured around moderate base pay, that is $157,000 500, and selective guarantees. At the margin, consumer finance and analytics accounted for 1.5% of hires, reflecting targeted demand from FinTech, credit analytics, and data-driven lending platforms. Hiring in this segment was closely tied to risk modeling, pricing, and regulatory compliance, keeping both hiring volumes and compensation relatively contained. While the median base salary for the industry remained anchored at $175,000, guaranteed compensation expanded to $70,000, lifting total median pay to $245,000. Employers across finance increasingly use guaranteed cash to offset uncertainty around exits, deal timing, and discretionary bonuses. Financial services hiring at Columbia reflects a market that did not broaden but reallocated opportunity toward execution-critical roles, paying fewer hires more securely in a cycle defined by capital discipline over optimistic expansion. If you want to learn more about Columbia MBA salary and placement trends for the past 5 years, subscribe to F1GMAT Premium at premium.f1gmat.com/subscribe.